Well, hello, and welcome back to Principles of Accounting 2. I am your host, Dr. B. Today we are exploring the concept of variance costs. Uh, in today's session, we'll discuss evaluating variance from standard costs. What this means is we'll be looking at the variances, otherwise known as the differences in cost from standard costs. As we discussed in the very beginning of the semester, this course is based off of manufacturing concepts, and we are exploring costs from a manufacturing concept. So having said that, a lot of what we'll talk about today are based off of those concepts, and we're going to be discussing the differences between costs. Let's go ahead and get started. So as you recall, standard costs include direct materials, direct labor, and factory overhead. These are the three costs that make up the total cost of a product. We call these standard costs. And these costs can also be identified as being performance goals. In other words, the amount of cost that I would like to achieve for the total cost of a product. That's why it's a goal, right? My goal is to reduce my total cost of a product by X. That is a standard cost. So just the way to remember it is standard cost is the same as a product cost. So direct materials, direct labor, factory overhead, that is a standard cost. So we use standard cost systems to help us to identify these product costs. And in a standard cost system, management looks at how much product should cost, meaning it's standard cost, and how much a product actually costs. So when we talk about standard, we look at it as what direct material should cost, what direct labor should cost, and what factory overhead should cost. And we compare that to the actual cost of each component. So a way to think about it is, let's say we are a company that manufactures pens, okay? And each pen should cost us about 15 cents to make. 5 cents for materials, 5 cents for labor, and another 5 cents for factory overhead. It should cost me 15 cents total to make this pen. 5 cents for labor, 5 cents for materials, 5 cents for factory overhead. That is my standard cost. It's 15 cents to make this pen. In the standard cost system, we compare that to what it actually costs. Now, you know that sometimes, the cost of materials will go up or go down depending on what the market is doing. So the cost of the plastic, the cost of the metal, the cost of the ink, sometimes those costs go up or go down depending on the market. So if my standard cost is 5 cents, it might actually be 7 cents because the cost went up. That would be my actual cost would be 7 cents. So if my actual cost is 7 cents for the material and my standard cost is 5 cents for the material, my variance or my difference is 2 cents, right? And so we look at that information as managers to tell us what the variance is, or the difference, right? So that's the idea behind it. And you could say the same thing for labor. I said earlier, labor is 5 cents per unit. That's my standard cost. Well, if there's a labor negotiation and I have to increase the wages of all my employees by a few dollars per hour, that will increase my labor cost per unit. So if my labor cost per unit is currently at 5 cents, and based off of renegotiations, whatever, my labor cost increases to 6 cents. My actual is 6, my standard is 5, my variance is 1 cent. So when you hear the word variance, think the difference. So this allows us to focus on correcting cost variances. Now, as managers, we set the cost based off of the standard per unit, okay? Remember, standard cost, that's what cost should be for direct materials, direct labor, factory overhead. We know that the standard cost will probably be somewhat different than the actual cost. And the difference between the two is called the variance. And the variance can either be reported as positive or negative. And we'll talk a lot about variance. Or instead of positive or negative, we call it favorable variance or unfavorable variance. So accountants, engineers, and management personnel, they get together and they set the standards. They set the standard costs. And it's, of course, as you know, based off of direct materials, direct labor, and factory overhead. The engineers help with the materials and the labor. The accountants help with the overhead. And the management personnel help with the direct materials, direct labor, and factory overhead. The three components get together to set the standard costs. Now, we like to call standard costs ideal costs. An ideal cost is like what it would be in a perfect world. In a perfect world, my direct materials would be 5 cents for this pen. In a perfect world, my direct labor would be 5 cents per pen. In a perfect world, my overhead would be 5 cents per pen. But we know the world isn't perfect. In a perfect world, my total cost for this pen would be 15 cents. We know the world isn't perfect. Things happen. So those are my ideal standards would be 5 cents, 5 cents, 5 cents. But we know that things happen. There can be spoilage, imperfections, machine breakdowns, idle time, all of these things come into play. So ideal means perfect world. And the standards can sometimes be set by perfect world. However, they can sometimes be viewed as unrealistic. In a perfect world, my direct materials for this pen is 5 cents, but I know the world isn't perfect. So therefore, is the 5 cents the direct materials unrealistic? Possibly. So in order to attain my goal of 5 cents per unit of direct materials cost, I need to set my normal standards. Can I reasonably obtain the cost of 5 cents per unit? The answer is maybe. And it depends on a number of factors. How easy is it to make? How easy is it to mitigate any type of mistakes? Can I obtain the goal based off of historic prices? Maybe. But in order to set the normal standards or the normal prices or the normal costs, we need to identify if we can attain those standard prices or costs, and we need to be able to attain the cost within a reasonable effort, meaning I can easily obtain a direct materials cost for this pen of 6 cents. So if it costs 6 cents for direct materials, that's reasonably attainable. 5 cents might be a little unrealistic based off of, the ability to prevent mistakes, to prevent costs going up on materials, things like that, right? So 6 cents might be more standard, or might be a more normal cost for materials. So when you hear the word normal standards, think obtainable, easily reachable, not quite ideal, but doable. Right? There's normal standards. And as managers, we need to continually review these standards, review these costs. We know that direct materials, direct labor, factory overhead changes over time. It's pretty static for the most part. I mean, within 12 months, I can reasonably say my hourly rates are going to be the same. Within 12 months, I can reasonably say my price for direct materials won't change. Within 12 months, I can reasonably say that my factory overhead will be within a range. But we know that every 12 months, we need to look at the direct cost of direct materials, direct labor, and factory overhead and make revisions based off of the actual cost from the previous accounting period. And that's because we need to maintain standard costs based off of trends. Some people will say standard costs limit management from improving the quality. Standard costs are sometimes too difficult to maintain. Standard costs might cause employees to lose sight over larger objectives. Sure. Standard costs can cause employees to underlie their focus on their own operations. Maybe, yeah. These are some criticisms of standard costs. I'll say this much. From my experience, setting standard costs is really important. Why, you might ask? It provides you with a benchmark. It provides you with a reasonably obtainable goal for a cost. Setting standard costs, I personally don't see that as being a limitation for improving. I do see it as a benchmark, and to be able to hit that benchmark and exceed that benchmark, sure, yeah. But so I guess what I'm saying is take this criticism with a grain of salt, because it's not setting standard costs is not really a limitation in my mind. Your book might say otherwise, but in practicality sense, it's really not much of a limitation. So as we talked about in previous chapters, when we talked about budgeting, we talked about comparing actual performance to our budget, right? We talked about comparing actual to budget. And we could say the same when it comes to standard costs versus actual costs. We can use our budget as our standard costs, and we can compare our standard costs to our actual performance. So in other words, when we talk about standard costs, think about the budget, think about the budgeted, and think about the comparisons that we can make. So in this chapter, in this discussion, we're going to use Western Ryder as our example. This company manufactures blue jeans, okay? So the company sets their standard costs for materials, direct labor, and factory overhead. And the company separates direct materials, direct labor, and factory overhead into two buckets, two components. One is called the standard price, and the other one is called the standard quantity. Standard price, standard quantity. Think standard price, think standard cost. When you think standard quantity, think the amount I usually produce, or my goal to produce is standard quantity. So for example, we expect to manufacture 10,000 pairs of blue jeans for the next 12 months. That will be my standard quantity. I usually produce 10,000 pairs in 12 months. My standard price, well, like my standard price for direct materials, direct labor, factory overhead are the average that I've had in the past, so that will be my standard price per pair. We'll talk more about it, but I'm just trying to help you to set the stage. So to calculate the standard cost per unit for direct materials, direct labor, and factory overhead, we take the standard price times the standard quantity. Standard price times the standard quantity. And you've heard that concept before. So let's look at our example for manufacturing one pair of blue jeans. In this example, we're making one extra large pair of blue jeans. We have direct materials, direct labor, factory overhead, which, as you know, are the total costs of manufacturing one single unit. For the materials, to make an extra large pair of blue jeans, we require 1.5 square yards of blue jean material. And the current price of one square yard of blue jean material is $5. So to find our direct materials price per pair of extra large blue jeans, we take the price per square yard, $5, times 1.5 square yards needed to create one pair of blue jeans. That gives me a total direct materials cost of $7.50. Okay, great. Then, of course, I need my employees to manufacture the pair of blue jeans. The current hourly rate of my employees is $9 per hour. It currently takes 0.8 hours, 0.8, not 1 full hour, but 0.8, to manufacture one pair of extra large blue jeans. 0.8, it's like 50 minutes, right? So 50 minutes, or 0.8 hours, times $9 per hour gives me a direct labor cost per pair of blue jeans of $7.20. Now you might be asking, Dr. B, how did you get 0.8 as being 50 minutes? Wonderful question. So in accounting, we do not consider 1 hour to be 60 minutes. We kind of do, but so the way it works is you take 100 as your full hour, okay? Or 1 is your full hour. To get to 0.8, we take 1 divided by the total number of minutes to get us to 0.8, which is 50 minutes in an hour. I know it sounds funny, right, to calculate it out that way, but it's kind of like the technical way of calculating an hourly wage spread across 1 full hour. That's how to get the cost, right? So that's a way of thinking about, if you're wondering, what is 0.8 of an hour? It's technically 50 minutes, but it's extrapolated out to one full hour. So that's why it's represented as 0.8. It gives you some context behind that, the meaning of that. Now, factory overhead rate is $6 per hour, and we use a single plant-wide method to get $6 per hour. And the amount of overhead applied to each pair of blue jeans is 0.8 as well. So $6 per hour times 0.8 factory overhead is $4.80. So you add your direct materials plus your direct labor plus your factory overhead to get to a standard cost per pair of extra large blue jeans of $19.50. Everyone sees how we got there? Any questions so far? We're okay.
No questions so far. I'm okay.
Thank you, Chandler.
Digesting everything so far, Professor.
Yeah.
Awesome. Thank you.
Following along.
Genevieve, thank you so much.
I'm here, Professor.
I'm glad to see you, Angela.
Thank you, sir. Likewise.
Thank you. Very good. Okay. So now that you have a basic understanding of how the standard costs are comprised, the company sets the budget based off of their planned sales and production. You remember this from the budgeting chapter, I'm sure you do. So the company budgets for the cost for the materials, direct labor, and factory overhead by taking the standard cost and multiplying by the planned level of production. In other words, I take my $19.50, which is my standard cost per pair of blue jeans, and I multiply that by the number of units I expect to produce during the accounting period to get my budgeted cost. Right? The budgeted cost, also known as standard cost, are then compared to the actual cost during the accounting period. So here's how the cost variance part works. As I said earlier, the word variance means the difference. Okay? So we take our actual and compare it to our standard throughout the year, throughout the accounting period. If my actual cost is less than my standard cost, we consider that to be a favorable cost variance. Listen, anytime you come in under budget, that's favorable. If my actual cost is greater than my standard cost, that is called an unfavorable cost variance. It's favorable if the actual is under the budget, actual under the budget, actual under the standard, right? It's unfavorable if the actual is greater than the budget or greater than the standard cost. Isn't that a nice concept? Favorable means you're saving money. You're under the standard, right? Saving money. All right. Unfavorable, not so much. You're spending too much. Way of thinking about it, right? So favorable if the actual comes in under the standard. Unfavorable if the actual is greater than the standard. That's how the variance works. Remember, the word variance means difference. Now, as we know, since this is managerial accounting, we have a lot of internal reports. One of those reports is called the Budget Performance Report. What this does is it summarizes the actual costs, standard costs, and the differences for the units produced. Nice way of thinking about that is the actual cost compared to the standard costs. The difference between the actual and the standard is called the variance. The budget, and this is based on the actual production rather than the planned production. Oops, sorry. Okay, so looking at our earlier example, our company, Western Ryder, we manufacture blue jeans. During the month of June, our company manufactured and sold 5,000 pairs of extra large blue jeans. Each pair of extra large blue jeans, if you remember, the standard cost per pair was $19.50. So if I break out my calculator, 1950, oh, sorry, $19.50 times 5,000 pairs. Oh, oops, if I type that in right, times 5000 equals. Okay, so we have a variance. So 5,000 pairs times $19.50 gets us in at 97,500. 97,500 is our standard cost. 97,500 is our standard cost for 5,000 pairs of blue jeans. Now we see that the actual cost incurred for the month of June is $101,050. Uh-oh. What does that mean? Who can tell me what that means? Our standard costs are $97,500. Our total actual costs are $101,050. What does that mean? Is that favorable or unfavorable? Who can tell me and tell me why? Don't all answer at once now. Who
Would it
can
be
tell?
favorable?
So, Andre, our standard costs are $97,500. In other words, that's our budgeted cost, right? $97,500. We actually incurred $101,050. Is that favorable or unfavorable?
Unfavorable.
Why is that?
That's because you've occurred more than what you budgeted for.
You got it. 100% right. Very good. Well done. So yes, Andre is correct. We budgeted for $97,500. Our actual costs were $101,050. So clearly there is a unfavorable variance. But let's look at how and why. Let's see what happened, okay? So here's the breakdown. Direct materials. Actual cost was $40,150. We budgeted $37,500. That means we have an unfavorable variance for direct materials of $2,650. Okay, unfavorable variance for $2,650 for direct materials. For direct labor, our actual came in at $38,500. I budgeted, our standard cost was $36,000. That means we have an unfavorable variance for direct labor of $2,500. Our factory overhead, our actual costs were $22,400. I budgeted for $24,000, or my standard cost was $24,000. That means I have a favorable variance of $1,600. Okay. Now, Andre was correct by saying that we have a total unfavorable variance. That total unfavorable variance is $3,550. How did we figure that out? We took our actual minus our standard, and that got us to our variance. So to calculate variance, first you calculate your standard cost for direct materials, for direct labor, and for factory overhead, just like we did earlier, right? Then you take your actual cost, I'm sorry, let me back up. The first step is to calculate your standard cost for direct materials, direct labor, and factory overhead. How you do that is you take your standard cost per unit times the number of units produced. Okay, that will get you your standard cost for each element. direct materials, direct labor, factory overhead. Okay. Then you at the end of the accounting period, you take your actual cost minus your standard cost equals your cost variance. Remember, if the cost variance is, if the actual is greater than the standard cost, it is called unfavorable. If the actual cost is less than the standard cost, it is called favorable. And what we do is we add up all of our variances to get the total variance, whether it's favorable or unfavorable. Everyone sees how we got there? And does it make sense?
So, Professor, I have
Go
a
ahead.
question a little bit.
Please.
So the standard budget, the standard cost is basically what we budgeted for, right?
That's correct. Yep, absolutely.
Just making sure I follow.
Very good. I'm glad you follow. Yes. So Andre, the way to think about it is when you hear us say standard cost, think budgeted cost. And that's what we budgeted for. Very good. Excellent. Very, very good. Okay. Now that you have an understanding of the cost variance, let's talk about the manufacturing cost variance. This is the difference between the standard and the actual for the units produced. And what we do, just like we saw in our example, is we separate it out into their respective variances for direct materials, direct labor, factory overhead. But for control purposes, each product cost variance is separated into two additional variances. So right now we're going to think of it this way. What we just learned here, this is at like the middle layer. Now we're going to dig a little bit deeper and we're going to break this down even further, okay? Into two additional variances. Now here's how it looks. Okay. What we learned here on this particular part is we learned about the cost variance, the difference between the actual and the standard. And we did that for direct materials, direct labor, and factory overhead. Now, we can do that same process for both the quantity that we're producing and the price we're producing it at through the total manufacturing cost variance. Now, here's how that works. As you know, we have direct material, direct labor, factory overhead, and we have a variance for each one. Variance for direct materials, variance for direct labor, variance for factory overhead. We can separate out each variance. For example, in direct materials, we have a variance for the price of the direct materials, meaning how much we purchased it at, the raw materials at. And then we also have a variance in the quantity, how much we actually received. Okay. For labor, we have a variance in the labor rate, the dollar amounts per hour, budgeted dollars per hour versus actual dollars per hour. Same with time, how long it takes to produce it. Budgeted amount of time versus actual amount of time. For factory overhead, we have controllable variance, which is variable cost, right? Controllable. I can control my variables, right? The difference between the two, and the factory fixed volume variance. Remember, the word variance means difference. So for direct materials, I'm looking at the difference in the price that I paid for the materials. And I'm looking at the difference in the quantity I actually produced versus what I planned to produce. So forth and so on. We'll break each one down, okay? So starting with direct materials. With direct materials, I separate the actual and the price and the actual quantity. I compare that to the standard price and the standard quantity. So to find the actual cost of materials, I take actual price times actual quantity. And I compare that to my standard, which is standard price times standard quantity. Remember, the word standard means budget. Standard and budget are the same word, yeah? And the difference is the variance. Price variance and quantity variance. So this is the formula that we use to find those variances. Actual compared to the standard, actual compared to the standard. It gives you the variance. And we'll look at the example. Okay? For labor, it's the same concept. My actual labor is calculated based off of the actual hourly rate times the actual time used to produce each unit of material, or each unit of output. And I compare that to the standard rate times the standard time. And the total variance is the standard variance plus the time variance. And for factory overhead, we look at it based off of fixed and variable rates. And let's go ahead and take a look at how it's broken out. So to find the total direct materials variance, we look at the direct materials price variance and the direct materials quantity variance. Remember, the word variance means difference. So we're comparing the actual to the standard. The word standard means budget. We'll do the same thing with labor. We'll look at the direct labor rate variance, actual to the standard, and the direct labor time variance, actual to the standard. So looking at our example, and let's break this down, okay? Let's break this down. Our company reported an unfavorable direct materials cost of $2,650 when we produced the 5,000 pairs of blue jeans. Okay, how we got there to the 2,650? We took our actual minus our standard. Got to an unfavorable variance or difference of 2,650. How did we calculate the actual direct materials, and how do we calculate the standard direct materials? Now remember, the standard is the budgeted amount. I planned, or I budgeted, to spend $5 per square yard. And I budgeted to use 7,500 square yards. That gave me a standard direct materials cost of $37,500. When I actually produced it during the year, my actual price per square yard, I ended up paying $5.50 per square yard because the market price went up 50 cents, yeah? And the actual quantity I used was 7,300 square yards. So that gave me a total direct materials cost of $40,150. How I got that? Actual price times actual quantity. You with me so far? Does that make sense?
Yes, sir. Just soaking everything in.
Very cool. Thank you so much. Okay. And we apply that same concept to direct materials, direct labor variances. So we can see that the variance per square yard is 50 cents. I actually paid $5.50 per square yard. I budgeted for, or my standard cost is $5. So actual, $5.50, standard, $5. That is a variance per square yard of 50 cents. And the amount of quantity I used. My actual yards used was 7,300. My standard square yards, or my budgeted square yards, was 7,500. That gave me a variance of 200 square yards. The variance for the price per square yard is unfavorable. My actual was greater than my budget or my standard. My actual greater than the standard, that's unfavorable. So 50 cents per square yard, unfavorable cost. However, looking at the quantity used, I used 200 less square yards than the standard. That is a favorable variance for the quantity. So unfavorable variance for the price, because my actual was greater than the standard, and a favorable variance for the quantity because my actual was less than my standard. But of course, we need to take the price times the quantity to get the total variance. And that left us with a unfavorable variance. So actual price minus standard price, 50 cents. Actual quantity, 7,300, gets us to an unfavorable variance. Remember, if the actual price exceeds the standard price, it's unfavorable. If the actual price is less than the standard price, then it's favorable. Think of the word favorable, unfavorable. It's favorable if the actual is less than the standard. Actual less than standard, favorable. And then the opposite is also true. If the actual is greater than the standard, it is unfavorable.
Yo, thank you, Professor, for reinforcing this. Thank you.
Hey, my pleasure. Because you know that's probably one of the harder parts about this chapter, about this concept, is that understanding the terms, right? My pleasure. So, looking closer at the variance, how we calculated the variance. To calculate the variance for materials, we take the actual minus the standard, and that gets us 50 cents, times the quantity used, 7,300 square yards. That gets us to an unfavorable variance of 3,650 for direct materials. Everyone's good? Makes sense?
Yeah,
So far,
Professor.
Professor.
Yeah, it's starting to make sense now. And then you
Cool.
did reinforce the in favor and unfavorable. So
Yeah.
I'm starting to get it now.
Exactly. Yeah, I couldn't said it better, Ms. Maltz. It is for sure probably the most confusing part is understanding the difference between favorable and unfavorable. And I do know that, and just as a heads up, there are questions on the homework or the quiz or whatever it is, and then there are a few questions I believe on the. You'll see it again on the final exam. So definitely understanding the difference between favorable and unfavorable is going to help you for sure. Okay, so we talked about direct materials price. Now let's talk about direct materials quantity. As we know from our example, we came in 200 square yards under our actual came 200 square yards under our standard. So to find the direct materials quantity variance, we take the actual quantity minus the standard quantity times the standard price. So in our example, 7,300 square yards minus 7,500 square yards times $5 per square yard. Okay. When the actual is greater than the standard, it's unfavorable. If the actual is less than the standard, it's favorable. In this example, it's favorable because our actual came in less than our standard. So we take X to find the direct materials quantity variance. Remember, it's just a lot of it, it's just trying to remember the formulas. Actual quantity minus standard quantity. Actual minus standard, that's a negative 200 square yards. Times $5 per square yard, that's minus $1,000. Minus 200 times 5 minus 200 times 5 is minus 1,000. Remember, it's favorable if it's favorable if the actual is less than the standard. Here's a nice visual representation of the three components, okay? It's an okay visual, it's not the best. We can see actual versus our standard. Actual, 7,300 square yards times $5.50 per square yard, 40,150. The standard, 7,500 square yards budgeted times $5 per square yard budgeted, 37,500. We can see the differences. Direct materials price variance, 36,500. Direct materials quantity variance, 1,000. So, and then the actual quantity times the standard price, 36,500. It's okay. It's not the greatest pictorial. But if you take the total actual minus, the total actual minus the total standard will give you the total direct materials cost variance. Of course, it's unfavorable because it's over. So how's it all reported? When we report direct materials variance, we report it based off of the actual compared to the standard. And some reasons for this type of reporting is to show management what they need to do in order to, or what are some of the causes in order to reduce unfavorability. Because as managers, we don't want to have anything unfavorable. Unfavorable is not good, right? So in order to help us to identify causes for this, we look at the operations, and we look at the various departments to help us to identify some of the causes. This kind of gives us some ideas of what could be causing this unfavorable variance. Identifying the unfavorable variance and the cause of the unfavorable variance is really important to management. I know as a manager, I want to help to eliminate any type of waste, any type of overage. Those are usually not good things. So we as managers need to do a better job of identifying those. And we do that through the direct materials variance reports. Remember, unfavorable means that our actual is greater than our standard. Favorable means that the actual is less than our standard. I'm trying to reinforce that concept. It's very important that you understand it. Okay, so that was direct materials variance. Now let's look at the labor. Because as you know, direct materials, direct labor, factory overhead. Those are our three prime costs that go into the manufacturing of a finished good. So let's look at the labor variance. And let's look at our example. I like this example. It's a nice one, I think. Okay, so in the month of June, as you know, we reported an unfavorable total direct labor variance of $2,500 when we manufactured the 5,000 pairs of blue jeans for the month of June. Our actual cost for labor were $38,500. Our budgeted or our standard costs were $36,000. That gives us an unfavorable variance of $2,500. How did that happen? You might be asking. Remember, our standard rate per hour was $9 per hour. And our standard time, meaning the amount of time we expected to use in the manufacturing process, was 4,000 hours. So $9 per hour times 4,000 budgeted hours gives us a total standard cost per labor of $36,000. However, we actually incurred $10 per hour, and we actually used 3,850 hours, giving us a total actual cost for labor of $38,500. Now, just based off of this information, we can see what is favorable, what is unfavorable. Our actual rate per hour, that's unfavorable. We're over by $1 per hour. And our actual time used, that's favorable because it came under the standard. Break it down, break it down. Okay, so overall, it's still unfavorable because we ended up going over by $2,500 for labor. How did it happen? We have an unfavorable per hour rate of $1. Actual is $10. Standard was $9. So 10 minus 9 is 1. Quantity. Our quantity. We budgeted for 4,000 hours. We actually came in at 3,850. So that's a favorable variance of 150 hours. So let's figure out the actual variance, okay? So our actual rate per hour minus the standard rate per hour times the actual hours. Actual rate per hour, $10. Minus standard rate per hour, $9. So that's $1 times actual hours. My actual hours, 3,850. 1 times 3,850 is 3,850 of direct labor rate variance. Now, as you know, if the actual is greater than the standard, it's unfavorable. If the actual is less than the standard, it's favorable. You guys are gonna think about this in your sleep tonight. I can already tell you. Okay, so here it is. Actual minus standard, $10 minus $9, $1 times actual hours, 3,850. Gives us an unfavorable variance of 3,850. Everyone sees how we got there? Yes? Hopefully. Good so far, right? I haven't fried your brains yet. We're getting there.
Surviving so far.
All right, good. Good, thanks, Andre. Okay. Oh, I'm sorry, did I go back a slide? I must have. Yep, I did. I apologize. So this is, again, the pictorial, same pictorial as before, just the difference here is we're talking about labor. Your actual cost was 38,500. The standard cost was 36,000. That's a unfavorable variance of 2,500. So the idea behind this is, again, we're breaking it down by layer, right? We're breaking it down by direct materials, direct labor, factory overhead. That's the idea behind this concept is we're looking at the variance from a very granular level. So on the production report, just like we did with the direct materials labor variance or direct materials variance report, we produced a similar report for labor. And what this does is it helps management to identify any causation within the report. So if I have an unfavorable direct labor of 2,500, that could have been caused by having too much idle time for employees. Maybe the skill level isn't as good as it could be. There's a couple of ways to look at it, right? You know, why was it $10 an hour instead of the budgeted 9? What caused that to happen? Did I have some overtime maybe? That could have been it. You know, there's a number of different reasons for that. But it's important that management looks at that report to help them to identify these anomalies, to help management to hone in on anything that's unfavorable to be able to fix it, right? That's why those types of reports are important. And yes, we look at the amount of time, so we look at both the variance for the dollar amount per hour, the hourly rate, and we look at the variance for the amount of time we actually used versus the amount of time that was budgeted, or the standard time. So that is labor. Now let's go into factory overhead. Factory overhead, this is different. And you know that's different, right? You know, direct materials and direct labor, those are what we call prime costs. Now we're going back a ways, but direct materials and direct labor are called prime costs. Direct labor can also be considered a conversion cost. You remember that. And factory overhead is considered to be a conversion cost. Factory overhead is calculated differently because, as you know, factory overhead includes both fixed and variable cost components. Fixed cost would be something like a supervisor's salary or rent or mortgage. Those are fixed costs, right? Or factory depreciation. Those are fixed costs. But then we have variable costs as well in factory overhead. And that would include things like utilities, or indirect materials. Those are variable cost components. And so what we do to identify variances in overhead is we separate out the fixed and variable components. And what we do is we look at both fixed components and variable components in their respective areas, and what we can control and what we cannot control. So here's an example of identifying the factory overhead costs based off of levels of production. And we can see that we separated out the variable costs from the fixed costs. Now, as I said earlier, variable costs would include things like indirect factory wages, utilities, indirect materials. Those are variable. Now remember, variable costs change with the level of output. The more I produce, the higher my variable costs are going to be. And fixed costs are costs that remain the same regardless of the level of output. This would include things like supervisor salaries, depreciation for plant equipment, property taxes, insurance, things like that. Those are fixed costs. They don't change. Rent, mortgage. So to calculate the factory overhead rate per labor hour, we take the total factory overhead at 100% divided by the budgeted labor hours, 5,000. So total factory overhead cost at 100% divided by the 5,000 planned or budgeted labor hours gets us to $6 per hour for factory overhead. So to calculate the factory overhead rate, again, we take the budgeted factory overhead at normal capacity. Normal capacity means 100%. In this example, 30,000 divided by the normal productive capacity. In other words, the planned hours of production. 5,000 hours. So 30,000 divided by 5,000 hours is $6 per hour of factory overhead. So to analyze the overhead rate, we subdivide it for both variable and fixed. As we said earlier, we need to separate variable factory rate from the fixed factory rate. And this helps us to analyze our overhead. So to do that, for the variable factory overhead rate, we take the budgeted variable overhead at normal capacity. Normal capacity means 100% capacity. Okay? Divided by the normal productive capacity. That is 100% the planned labor per for that period, 5,000 hours. So $18,000 of variable overhead, that's at 100%, divided by the 5,000 planned hours, that's $3.60 per direct labor hour of variable factory overhead. For the fixed factory overhead rate, we do the same thing. But the difference here is we take the fixed cost at 100%. That's $12,000 divided by the 5,000 planned hours for production, gets us to $2.40 of fixed factory overhead rate. Now, of course, if you add the two together, you get $6 per hour. But the idea here is that we separate out variable from the fixed. Does everyone understand this concept so far?
Yes, so far so good.
Great. So when you think about the factory overhead, remember that we separate out the variable factory overhead from the fixed factory overhead. And what this does is it helps us to further analyze the factory overhead rate. So to get your total factory overhead, you add your variable factory overhead rate per hour plus your fixed factory overhead rate per hour. It's a total factory overhead rate, which is $6. But just remember these two formulas, okay? Variable factory overhead rate is your budgeted rate at 100% for variable divided by the labor hours planned. And then for fixed, it's fixed overhead rate at 100% divided by the total hours planned. That's how you get your rates. How fun. Okay, so let's look at variable controllable variance a little bit closer. This is the difference between the actual and the budgeted for production, for variable cost estimates. And to calculate that, we take our actual variable factory overhead minus our budgeted variable factory overhead. It's just like before. We're trying to find the variance, so you take your actual minus your budget or your standard cost. And we're just doing that for the, we do it for both fixed and variable to find the difference, right? Again, we're just getting more granular. It's the same exact concept as before. And remember, if the actual is less than the budget or the standard, it's favorable. If the actual is greater than the budget or the standard, it's unfavorable. So the budget for variable factory overhead is calculated by taking the standard hours for actual units produced times the variable factory overhead rate. Now, the standard in our example is 4,000 hours. That's what we budgeted for. Times times the variable factory overhead rate of $3.60. That gets me to 14,400 of variable factory overhead. So looking at our example, let's assume that our actual cost in the month of June for variable factory overhead was 10,400, and our fixed factory overhead was 12,000. Gets us to an actual factory overhead of 22,400. Well, that's cool. Now I can see that my variable factory overhead variance is favorable. How do I know that? Well, my actual came in at 10,400, and as you know, we budgeted for 14,400. So actual minus the standard or the budget, the difference here is $4,000. That's favorable because it's minus $4,000. Isn't that nice? I like when we come in favorable. Favorable is a great thing. So what does all this tell management? Well, it helps management to keep costs within control. And it helps management to manage their variable costs. So we looked at it from the cost perspective. Now you know we got to look at it from a volume perspective. So at 100% rate for volume, we need to look at the volume variance. To find the volume variance, we take the 100% rate, a normal capacity, minus the standard hours for actual units, times the fixed factory overhead rate. Now this tells us the use of fixed factory overhead. In other words, how frequently we're using our property, plant, and equipment. Unfavorable, do I need to tell you? I'll tell you. Remember, it's unfavorable if the actual is greater than the standard. It's favorable if the actual is less than the standard. Okay, so looking at our example, the standard hours at 100% capacity is 5,000 direct labor hours. I budgeted 4,000 direct labor hours. So 5,000 minus 4,000, that's 1,000. Times my fixed factory overhead rate of $2.40. So 1,000 times $2.40 is 2,400. This is an unfavorable variance. Because, of course, it's over the standard. Here's a nice graph that represents this concept. We can see it's when it's unfavorable on the left side of the graph. We see when it's an unfavorable volume when when our labor hours and our cost based off of the budget is over, right? The opposite is also true. The idea here is that in an ideal situation, ideal situation, we would come in at 100%, meaning our planned labor dollars, 12,000, come in at right at our 5,000 direct labor hours that we budgeted for. Once it goes over, it kind of gives you an idea of, and this is based off of capacity, right? In other words, when you look at this graph, it means if it's unfavorable, if we're underutilizing our overhead, underutilizing our machinery, because we're talking about fixed variance. The fixed variance is the only one that's really opposite, right? Because if I am not using all of my machines to their 100% capacity, they're being underutilized. And when that happens, because my fixed overhead is still going to be $2.40 per hour, regardless of how much I'm using my machines. If I'm not using my machines at 100%, it's going to be unfavorable. So I hope that helps to clarify that. Things that contribute to unfavorability: failures in workflow, machine breakdowns, work stoppages, lack of sales. Of course, those are terrible things that happen. Okay, we're almost done. So looking at our overhead variance, we look at, as you know, for factory overhead, it's variable plus fixed. So variable plus fixed, our total variance for favorable, or I'm sorry, our total variable factory overhead was minus $4,000. That's favorable because it's less than the budget, less than the actual. And our fixed factory overhead variance was 2,400, unfavorable because it came in greater than came in greater than our budget. And that gave us a total factory overhead variance of 1,600, favorable, which is why our total factory overhead was variance was favorable. Came in less than the budget amount. And for factory variable overhead variance report, it helps management to identify controllable costs within factory overhead, and it helps management to better utilize the machines and the individuals. And here's an example of what the report looks like. Actual minus the budget gives you the variance. We can see how those variances are calculated based off of the spreadsheet. Pretty cool, huh? I think it's cool. Okay, a couple more to go. In our example, we produced 5,000 extra large pair of blue jeans during the month of June. Our standard hours was 5,000 for 5,000 pairs of blue jeans. Is 80 cents per per direct labor hour, or 0.8 per direct labor hour. The 0.8 is the 50 minutes it takes to produce each pair of blue jeans. So 5,000 pairs of blue jeans times 50 minutes, or 0.8, times the standard rate, $6 factory overhead per hour, gets us to 24,000. So 5,000 pairs of blue jeans times 50 minutes per pair of blue jeans gets us to 4,000 direct labor hours, times $6 per direct labor hour of factory overhead gets us to $24,000 of applied factory overhead. To find the variance of total factory overhead, we take the actual minus the applied. Actual factory overhead was 22,400. The applied factory overhead was 24,000. Gives us a favorable variance of 1,600. Okay. At the end of the accounting period, as you know, the factory overhead normally has a balance. In some cases, we either under-apply or over-apply factory overhead. When we under-apply factory overhead, it happens because the actual was greater than the applied factory overhead. It's under-applied, meaning we under-applied it. Or we didn't budget enough, is another way of looking at it. And the opposite is also true. So if factory overhead has a debit balance at the end of the accounting period, it's because we under-applied factory overhead. If the factory overhead account has a credit balance at the end of the accounting period, it's because we over-applied factory overhead. And the variance, or the difference in the factory overhead, comes from the difference between the applied and under-applied factory overhead. If it's under-applied factory overhead, it's unfavorable. Under-applied, unfavorable. That means we didn't allocate enough in the beginning, right? If it's over-applied, it's favorable. That means we over-applied, we covered that cost. And this is our T account. Oh my goodness, T account. You probably haven't heard that term since Principles of Accounting 1. This is our T account for factory overhead. It shows the actual in comparison. The actual factory overhead, 10,400 plus the 12,000 of fixed, 10,400 variable plus the 12,000 fixed factory overhead, giving us to 22,400. On the right side of the T account, we see our standard cost, 24,000, which means we over-applied factory overhead of 1,600. That is favorable. This kind of just sums that up. So it's very, very similar, very, very similar in comparison to when we looked at direct materials, direct labor. Similar process anyway. Then why don't we record it? Standard costs used in management to control costs separately. Remember, when we talk about factory overhead, we separate the direct, I'm sorry, when we talk about factory overhead, we separate the fixed cost from the variable cost. We do the variance for both fixed and the variable, the variance report. So looking back at our example, So our company, let's say we purchased on account, okay, this is a journal entry. We purchased on account 7,300 square yards of blue jean material at $5.50 per square yard. The standard cost of the material, the budgeted cost is $5 per square yard, giving us a cost variance, as you know, of 50 cents per square yard. This is how we record the journal entry. Okay, so 7,300 square yards at $5 per square yard is 36,500 of direct materials. So we debit our direct materials, our raw materials account, debit raw materials account 36,500. We take the actual amount of yards purchased times the standard price per square yard. Then we debit direct materials price variance account. The direct materials price variance account, remember the word variance means difference, is the difference between the standard and the actual. So how did we figure that? Remember the difference is 50 cents per square yard. So 50 cents times the number of square yards purchased, 3,650. And then we credit accounts payable. The square yards that we actually purchased times the price we actually paid, 40,150. Everyone sees how we got there? This is the journal entry that we would make.
Yes, I think I'm with you.
Great. So the idea behind this account called direct materials price variance, that is the account that represents the difference between the budget or the standard cost versus the actual. And since the difference is 50 cents times 7,300 square yards, 3,650. We do the same thing with the quantity. Work in process. We plan on, what did we plan? Yeah, we planned on, or our standard is 7,500 square yards of material times the standard cost of $5 per square yard. We debit work in process. Remember, work in process is a part of the assembly process, right? Remember that from earlier on? It's 37,500. We credit materials, these materials actually used, 7,300 square yards times the standard price, $5 per square yard. We credit materials, raw materials, 36,500, and we credit the direct materials quantity variance of 1,000. How 1,000, you might be asking? The variance for the quantity is 200 square yards at 200 square yards at $5 and, I'm sorry, is it 250 square yards? I think it's 250 square yards. Yeah, no, it's 200 square yards at $5 per square yard, 1,000. Sorry, took me a second to get there.
Hey, Professor, where did you get 200 again?
Yep, so that's the variance, right? And the 200 square yards is the variance. We remember, Andre, we budgeted 7,500 square yards. That's our budget, or our standard. But we actually used 7,300.
I see now. I see. The difference between those two is 200.
Exactly right. Yep. And then we multiply the 200 times the $5, which is the standard price, to get 1,000. Excellent. Very good. Good question. Okay, so as you know, at the end of each accounting period, we make this the journal entries to reflect the changes in the raw materials, work in process, finished goods, and those are based off of the changes throughout the accounting period. Oh, and remember, if the standard is greater than the actual, it's favorable. If the standard is less than the actual, it's unfavorable.
Unfavorable.
Yeah, you guys are going to be thinking about that all night long. It's like, oh, it's unfavorable. It's favorable. You'll be dreaming about it. Okay, so yeah, we make a bunch of journal entries for factory overhead at the end of the accounting period, for underapplied and overapplied, just like we talked about earlier. And so that's part of that process as well. At the end of the accounting period, balances for variances indicate if it's favorable or unfavorable for the period. Yeah, and we use that information to help us to make improvements. So yeah, that's fun, right? I think it's fun. The variances are not reported to external users. Remember, these are internal reports. We're talking about managerial accounting, principles of accounting 2. We're talking about internal reports. Variances, we don't report those to our customers or to the government or to investors. That's for internal use only. And in helping us to prepare the income statement, these are transferred to the cost of goods sold. Cost of goods sold, as you know, is on the income statement. Goes from finished goods. And if we're looking at a service business is a little bit different. Where you could use variances in a hotel business, for example. You can look at those types of differences in a
Hardware
hotel.
stores.
Yeah, department stores, exactly. Yeah, most definitely. Retailers or hotels, as a service business, the variance can be looked at. Like, for example, let's look at housekeeping. This example is for Marion. Oh, that's funny. This is for housekeeping, right? And so we have our standard labor cost, the standard hourly rate for housekeeping, and we have the standard amount of time it takes to clean each room, right? So 42 minutes per room. Housekeeping is paid $13 an hour. So that can give you the amount it takes housekeeping to clean each room, okay? And so if we use the information given to us, we have number of guest room nights, 1,500. We have the number of housekeeping staff hours, 840 hours total for housekeeping hours. Number of guest room nights, 1,500, multiplied by the standard hours per room, that's 42 minutes. That's 70 cents per hour per room. And the standard housekeeping staff hours is 735. So if the standard is 735, actual or budget amount 840 hours minus the standard 735 times the hourly rate, $13 per hour. That's $1,365 of unfavorable time variance for housekeeping. So this example kind of shows you how you can apply the same concepts to a service business like a hotel. I know some of you are in the hospitality industry, or you're hoping to get into the hospitality industry. So this will help you in that type of calculation, should you ever need to do it. And that, my friends, is the end of today's lesson. I want to first ask, are there any questions on what we just learned? Or are we okay? And then we'll talk about what's going on in the class.
I'm okay. I will have to go back and look at some things, but
Sure.
I'll definitely have to go back and look at some things. But I'm okay.
Great.
That will be all for me.
Sounds good, Miss Smalls. And if you ever run into any trouble, you just let me know, okay? Just, give me a call, shoot me an email. I'll get you, I promise. Very good. Anyone else? Are we okay for what we just learned? And then we'll talk about what's coming up.
So far, everything that we went over, just gotta review it, let it sink in, and then when the homeworks come, I'm gonna send an email, of course, when I have a tough time answering a question.
Sounds good. Yeah, if you're running into any problems on the homework, just let me know. I'll be happy to help you out.
I'm good so far.
Sounds good, Tamika. Thank you so much. Appreciate you. Appreciate you joining us.
Mm-hmm.
All good here too, Professor.
All right, Angela,
I'm
sounds
good for the
good.
most part as well.
Chandler, you good? Great, fantastic. Okay, so let's go ahead and take a look in the classroom. Where are we? What's going on? Okay, so we just covered chapter 23, which is in week 11. 11, can you believe it? Oh my goodness gracious, time is going by quick. So, what's going on? So last week we did chapter 22. You should have completed your chapter 22 quiz. If you didn't, you got a 0. I entered that in. I apologize for that, but remember, we need to make sure that we get things done on time every week. It's very, very important to get stuff done on time every week. Very, very important. What do we have going on for this week? We have the chapter 23 homework assignment. As you know, it's in Cengage, so go ahead and click on chapter 23 right here. And week 11, it'll take you to the homework assignment. Let's talk a little bit about where we're going. Week 12, next week, you have chapter 24 quiz. Week 13, you'll have chapter 25 discussion board. Remember, discussion boards they carry the same weight as a homework or a quiz does. Make sure you're participating in all the discussion boards. I'm telling you, if you miss them, you're missing 5% of your total grade. Don't do that. Okay? Please participate in all the discussion boards. I can't stress that enough. Each one is worth 5% of your total grade. If you missed 2, like some of you already did, you just missed 10% of your total grade. You dropped a whole letter grade by not participating in the 2 discussion boards that already happened. That's bad, okay? That's a whole letter grade. So please, do the best you can. Participate all the time. Very important. So that's week 13. That's 2 weeks from today. Then we'll roll into module 4, the last module. Week 14, we'll cover chapters 26, chapter 26 quiz. Week 15, we're going to do 2 chapters that day, 27 and 28. Oh my goodness, 2 chapters. I can already hear you. I know. Don't worry, they're short chapters. We'll get through it. Week 15, very busy week. You'll have chapter 27 homework, chapter 28 quiz. I'm sorry, chapter 28 discussion board. Then week 16, final exam. And that'll be due by May 4th. Okay, so we're getting there. Time is going by real fast. So my advice to you is not only would I try to work on this week, you might want to think about working ahead. Okay, this will help you to plan properly for the future. We want to make sure that you're all caught up and you're working ahead, because let me tell you, when we get to week 15, it's going to be chaos. Okay, you got 2 chapters. We got a lot of things going on next month. It's a busy month, so just plan ahead. That's my word of advice. Any questions, comments, concerns, anything at all? We're okay?
I got one question, Professor.
Andre, go ahead.
For those who are graduating shortly, is there a different exam date? I'm just asking because another class of mine, I remember they was talking about having like early exams or something.
Yeah, glad you asked. So let's take a look. So looking at udc.edu, we are going down to the academic calendar. And we will, let's take a look. So for those of you who are graduating, and yes, I will be getting a list for those of you who are graduating. The short answer is yes, Andre. For those of you who are graduating, the final exam date is actually, oh my goodness, look at that. April 23rd is when those need to be done by. April 23rd. Well, technically the last day of class is April 24th, which is, yeah, it gets tight, right? You'll be okay.
Indeed, we're so close.
We are getting so close. My goodness, that's only a month away. So, what does this mean? For those of you graduating, you're gonna have to work a little bit ahead. And I'll let you know beforehand what needs to be done. We'll get you there. But thank you for bringing that up, Andre. I appreciate you mentioning that.
No problem, Professor. I appreciate you. Thank you.
Of course. And I'm always here for you anytime you need me. Okay, so any other questions before we call it a day, an evening? We're good? Okay, wonderful.
We're good.
Sounds good, Angela. Okay, so you all, if you ever need anything, you let me know. I'm here for you 100% of the time. Please stay safe. Wash your hands. Do the right things. And I'll see you again next time. Same time, same channel next week. Have a wonderful, wonderful evening. Take care, y'all.
Thank you. You too, Professor. Have a good
Thank you.
evening.
Thank you so
Thanks,
much.
Professor.
Bye-bye.